The familiar drumbeat has started again. Former President Donald Trump is turning up the volume. He's making dramatic demands on the Federal Reserve, America's central bank. His message is clear-cut interest rates, and do it fast. He believes the current rates are choking the United States economy. This isn't a quiet suggestion, it's a public pressure campaign. Trump argues that high borrowing costs are a self-inflicted wound. He sees a looming economic slowdown if the Fed doesn't change course. This public call to action sets the stage for a significant economic debate with global implications, as we see different strategies playing out worldwide. Across the Atlantic, a very different picture is emerging. While the United States Federal Reserve has held interest rates steady, making no cuts, Europe is moving. The European Central Bank, or ECB, has already cut its key interest rate multiple times. In fact, they've made 4 separate cuts recently. This divergence is stark. Imagine 2 ships in a global economic ocean. One is trying to slow down by keeping its anchor down, while the other is trying to speed up by raising its sails. This contrast raises serious questions about which approach is correct for the current economic climate, and what the consequences might be for both economies. So, why is Mr. Trump so insistent? He looks at Europe's actions and sees the United States falling behind. He argues that higher interest rates in the United States make American businesses less competitive. If European companies can borrow money more cheaply, they can invest more, potentially grow faster, and undercut American firms. Trump's concern is that the Fed's caution is putting the United States at a disadvantage. He paints a picture of an American economy being held back by its own central bank, while other major economies are taking steps to stimulate growth and avoid stagnation in their respective regions. This isn't just a dry economic disagreement between policy experts. It's rapidly becoming a significant political flashpoint. The Federal Reserve is designed to be independent of political pressure. Its decisions are supposed to be based on economic data, not political agendas. However, when a prominent figure like Donald Trump, with a massive public platform, repeatedly criticizes the Fed, it puts that independence to the test. This clash highlights the tension between short-term political desires for economic boosts and the central bank's long-term mandate to maintain price stability and employment, a delicate balancing act. Donald Trump's argument is straightforward from his perspective. He believes interest rates are simply too high, acting as a brake on economic expansion. He contends that the threat of inflation, the boogeyman often cited by central bankers, is overblown. In his view, the data doesn't support the level of caution being exercised by the Federal Reserve. He points to signs that the economy could be stronger, but is being artificially constrained by borrowing costs that discourage investment and consumer spending. He paints a picture where lower rates would unleash a new wave of growth, benefiting businesses and workers alike, creating a more vibrant economic landscape for everyone. Furthermore, Trump suggests that the Federal Reserve, under Chairman Jerome Powell, is being overly cautious, perhaps even misreading the economic tea leaves. He implies that the Fed might be too slow to react to changing conditions, risking a potential slowdown or even a recession. The former president often frames this as the Fed being out of touch with the needs of ordinary Americans and businesses. He argues that the risk of inflation returning with a vengeance is minimal compared to the immediate risk of economic stagnation caused by rates that are, in his opinion, unnecessarily restrictive and harmful to the nation's overall financial health and its competitive standing. On the other side of this high-stakes debate stands Jerome Powell, the chairman of the Federal Reserve. His position, and that of the Fed's board, is rooted in a deep-seated fear of letting inflation get out of control. They remember painful periods in economic history when runaway inflation eroded savings and destabilized economies. Powell emphasizes that the Fed's primary mandate is to maintain price stability, which they typically define as keeping inflation around a target of 2%. He argues that cutting rates too soon could reignite inflationary pressures that they have worked hard to bring down, a scenario he is keen to avoid at all costs. The Federal Reserve's caution is driven by a desire to make decisions based on comprehensive economic data, not political pressure or short-term market fluctuations. Powell and his colleagues stress that their goal is a soft landing, taming inflation without triggering a recession. This requires careful navigation and patience. They believe that premature rate cuts could undo the progress made in controlling inflation, potentially leading to a situation where even tougher measures and higher rates would be needed later. This careful, data-dependent approach is fundamental to their strategy, even if it draws criticism for being too slow or too conservative. The decisions made by the Federal Reserve, whether to cut rates as Trump demands or hold them steady as Powell prefers, have immediate and far-reaching consequences. If rates are cut too quickly, there's a risk that inflation, which the Fed has been battling, could surge again. This would mean the cost of everything, from groceries to gasoline, could start climbing rapidly. An overheating economy might feel good initially, with lots of spending and activity, but it can quickly become unsustainable. Furthermore, aggressive rate cuts could weaken the United States dollar, making imports more expensive and potentially fueling even more inflation down the line for American consumers. Conversely, waiting too long to cut rates, or keeping them too high, carries its own set of significant risks. Businesses might postpone investments because borrowing money is expensive. Consumers might delay big purchases like homes or cars. This slowdown in economic activity could, if severe enough, tip the economy into a recession, leading to job losses and financial hardship for many families. The Fed aims to avoid this hard landing, but threading the needle is incredibly difficult. High rates also mean higher mortgage payments and credit card interest, directly squeezing household budgets across the country, making everyday life more expensive for millions. Financial markets are acutely sensitive to this tug-of-war. The mere hint of a rate change, or even comments from Trump or Powell, can send stock prices soaring or tumbling. Banks' profitability is also directly affected. Higher rates can mean better margins on loans, but if rates are too high for too long and the economy slumps, loan defaults could rise. The United States dollar's value on the global stage is also in play. A stronger dollar, often a result of higher United States interest rates relative to other countries, makes American goods more expensive for foreigners, potentially hurting exports. This uncertainty creates a volatile environment for investors. For regular people, these macroeconomic debates translate into very real changes in their financial lives. If interest rates are cut, mortgage rates might fall, making homeownership more affordable. Savings account interest might also decrease, which isn't great for savers. Car loans could become cheaper. On the other hand, if rates stay high, borrowing costs remain elevated, impacting decisions about major life purchases. The overall cost of living, influenced by inflation, is a constant concern. The Fed's decisions directly influence how much money families have left at the end of the month, affecting their ability to save, invest, or simply make ends meet. The Federal Reserve's decisions on interest rates inevitably become entangled with politics, especially in an election year like 2025. The state of the economy is a major factor for voters. If people feel financially secure, with stable jobs and manageable living costs, the incumbent party often benefits. If, however, there's economic turmoil, high unemployment, or rampant inflation, voters may look for a change. Trump's pressure on the Fed can be seen as an attempt to influence economic conditions to his political advantage, hoping lower rates might create a short-term boost before voters head to the polls, shaping perceptions of economic stewardship. This political pressure places the Federal Reserve in a difficult position. The institution's credibility rests on its independence from partisan politics. Its mandate is to make tough decisions for the long-term health of the economy, even if those decisions are unpopular in the short term. If the Fed is perceived as caving to political demands, it could undermine public trust and market confidence in its ability to manage the economy effectively. Maintaining this independence is crucial, as it allows for objective policymaking aimed at benefiting all Americans, not just one political faction or agenda, ensuring stability over expediency. Ultimately, what's at stake in this battle over interest rates is the economic well-being of all Americans. The Fed's choices impact job security. A misstep could lead to higher unemployment. They affect purchasing power. Uncontrolled inflation erodes the value of every dollar earned. The stability of the banking system and the overall financial markets also hinges on prudent monetary policy. These are not abstract concepts. They are the foundations of daily life and future prosperity for families across the United States. The path forward requires careful consideration of all potential outcomes, balancing immediate needs with long-term stability and growth. The work of the Federal Reserve, though often complex and conducted behind closed doors, is fundamental to the American economy. Its decisions about interest rates and the money supply have a profound impact on everyone, from Wall Street investors to Main Street business owners, from retirees on fixed incomes to young families buying their first home. Understanding this ongoing conflict and the principles guiding the Fed is crucial. It's not just about numbers and charts. It's about the financial health of the nation and the economic future we will all share, highlighting the immense responsibility the central bank carries.